Hey, Jason's here. In this Jason's Brain Dump video, I wanted to talk about something that I'm pretty passionate about, something I enjoy doing, and that is investing. The reason why I'm doing this video, in case you haven't noticed, the world is crazy right now, and the financial markets are even crazier, right? That's probably all that you're getting in the news between conflicts, COVID, the latest disease, or whatever that's out there, is talk about recession, talk about how the stock market is just falling, how the crypto market has collapsed, all kinds of craziness. But truth be told, these are the moments where more wealth can be created and built if we're just smart about what it is that we do. And so there's a lot of people that want to take advantage of the market and get in. They know they want to put money in because, right, you want to be fearful. Sorry, you want to be greedy when people are fearful, as Warren Buffett says. But a lot of people just aren't familiar with how to put money into the market. And this strategy kind of removes emotion and kind of gives you a plan. Now, I will say that again, I use this for more longer term strategy, basically assets that I plan on holding for years. You can use it on a shorter time frame, but this is specific to money that I was potentially going to put into the market anyway, and I'm not going to be watching it day by day by day. So I'll also say that monthly DCAing, right? Monthly contributions into a mutual fund, stocks, whatever it is that you invest in, has time and time again be proven to be a very profitable strategy for growing and compounding your investment money. So again, this shouldn't replace anything. This is what I use when the markets, again, are fearful, and I use it in addition to my normal monthly investments that go into the market. I'll go ahead and say this is what I do. This is not supposed to be any kind of financial advice. This is not supposed to be a replacement for anything that you're currently doing. I just like to share what it is that I'm doing, and maybe it benefits someone or give someone an idea of something they can adapt to their own strategy. Now, this strategy can be used really in any kind of equity market. I typically use it for stocks and in crypto investments. And again, this is in addition to money that I would normally be just on a monthly basis contributing. This is where, hey, markets are going crazy, prices, stocks are falling, crypto's falling, and I have a chunk of money that I want to get into the market, but I want to be strategic about it. I don't want to just throw it in all at once. Maybe a plan to get it in there in a controlled manner so I don't put it in too early and maybe risk putting it too late. It's just a strategy that removes all the emotion and guesswork out of it. All right, so what we're going to do is we're going to head to the charts. This strategy is what I call the flip the dip strategy. I just made that up, and it is based on using the Fibonacci sequence, Fibonacci ratios, to enter the market again in a controlled fashion. So if you are unfamiliar with Fibonacci, I encourage you to go check it out. It's very fascinating stuff. Fibonacci sequence can be found in nature, in biology, in the financial markets. Again, check out Fibonacci. I'm not going to go into extreme detail here. Bottom line is a series of numbers based on a sequence, and things tend to be built around it and or react around it when it comes in terms to the financial market. Most charting tools. Now, what I'm using here, let's just get in, and we're looking at the S&P 500, the Spider S&P 500 ETF. And what we see here is a weekly chart. I like to use this on a higher time frame. And these lines here were put here by the Fibonacci tool, and these are essentially lines based on the Fibonacci ratio. So you can see here 0.236, 0.382, 0.5, 0.6, 0.786, and then there's 1, and of course 0 at the top. The way this tool works, let me just go ahead and delete it. Most charting, again, TradingView I use, it's a free tool. There's a paid version, I pay, but I think you have access to it for free. It's just that if you want to upgrade and get extra features and stuff, you can pay for it. So if you're using TradingView, again, it's free. There's other free charting software out there. There's other paid things out there, but ultimately they all have something that's called a Fibonacci tool, Fibonacci retracement tool. What we're doing here is we're just taking a look at the market. Again, I like to go into the weekly time frame and do this, and we're just looking at the natural flow of the market, right? As we can see here, you can see the date towards the bottom here of the screen. You can see that this is the COVID crash right here. And so we have this big dip, and then we have essentially a market top. And that's kind of what we're looking for to execute this strategy, right? Because once we have a top because the market is starting to go down, okay? And so this is where we want to start taking advantage of getting into the market, what they call buying the dip, right? But we just want to be a little bit smarter about it. But this is when we want to start getting in, right? The market's coming back, and now we're assuming, right, just over time, as we look at the history of this, I think this ETF goes back to like 2004 or something like that. Oh, way farther than that, 1994, right? So as we can just see, Again, this is based on the S&P 500 top US companies, essentially, give or take. What we're doing here is we're just kind of looking at the trend, and overall, the market is in an uptrend, right? We're moving up. The path is up. Okay, and that's typically how it works, right? On average, I think over the history of the market, it returns something like, just the S&P here, returns something like 10 to 11% on average per year. That accounts for dips, that accounts for big rises. Some years is up, some years is down, but on average, 10 to 11%. We can just assume, again, it doesn't guarantee anything, it doesn't mean anything. We could absolutely lose all our money, but we can assume that when a market dips, it will eventually come back. Okay, this potentially won't always be the case, but in these days, we can assume that we will get through whatever this is and we will recover. Okay, so you can see here, this was the dot-com bubble where we essentially fell, what was it, about 50%. So this top 500 companies essentially represented in this fund here, or this ETF, essentially lost 50% of its value, but then it went back up. And then what happened? We hit the 2007, 2008 kind of housing crisis, other things going on, but that's what happened here. So we took another dip, right? And what did we have? We went from top to bottom, nearly 60%. But then what we do? We start continuing the uptrend, had a couple dips here and there. Then the last major dip we had was the COVID dip, as you can see right here. So from top to bottom, we dropped about 35%. Okay, so we've seen 35 to 60%, right? With all the talk of how crazy, we printed all this money during COVID, inflation's gone crazy. We can probably assume that we'll probably see something potentially 30 to 60% drop, right? And so right now from the top, we are down 20%. So if history repeats itself, doesn't always, we're potentially going to see at least another, here's 35%, and potentially if it drops back down, say 50 to 60, then we're going back to about the lows of COVID. So I'm showing you this because there's a lot of people like, ooh, markets are down, I want to put some money in, I'm going to put some extra money in. Well, we don't know how far it's going to drop, right? So we want to be smart about our entry, and that's where, be smart about our investing, and that is where the Fibonacci tool comes in. So in TradingView, it's up here, we call it Fibonacci retracement, and you draw it from left to right. So I'm going to start at the bottom right here. I'm going to start at the latest big bottom, which here is COVID. Okay, so I'm going to click, and you see how the line's down there. And now I'm going to just drag this up to the top. Okay, so I like to use the nearest closest big bottom, right? So I'm using this one instead of this one because it's lower, right? It's also the most recent. And this is kind of a big major dip, right? So I want to use this. And then of course, here's the top. Here's the highest we've gotten before we started to come back. So our strategy is really simple. We are simply going to start putting investments in when the price of whatever it is that we are wanting to invest in, whether it's a stock, a crypto asset, we are going to wait until it hits the 0.5 here, okay? And that is where we are going to put in our first investment of potentially 4. So essentially what we're going to do is we're going to take an amount that we want to invest. Say we have $5,000 that we want to invest, okay? Once it hits 0.5, the price, I'm going to put 10% of what I want to invest in total in at the 0.5 level. Then once we come down to the 0.618, which is the golden fib ratio, again, you can read up on that with the golden fib, the golden the golden ratio. You can see what that's all about. Really cool stuff. Once it hits that 6.618, I'm going to put in 20% of my investment. Once it comes down and hits the 0.786, I'm going to put in 30% of my investment. And then if we get down to the 1, I'm going to put in 40% of my investment, and that will equal the 10, 20, 30, 40. That is 100% of my investment I'm fully in. So if I was putting in, say, $5,000, okay, I would put 10% of $5,000 here in at the 0.5. Okay, so that'd be $500 that I would be investing here. Once we come down to 0.618, I'm putting 20% in. So 20% of 5,000 is 1,000. So I put $1,000 worth of investment in. And then 0.786, that is 30%. So again, 30% of 5,000 is 1,500. I would invest 1,500 in at this point. And then when we come down to the 1 level, I would put 40% of the investment in. So again, 40% of 5,000 is $2,000. So I would be adding $2,000 worth of investment here. And as you can see, what happens is we ultimately are starting to put in our money, but we put in less, right? We're putting in more as the price drops more, right? So we're taking advantage of the lower pricing. We're spreading ourselves out. So we're not all in up here only to have it drop another 30 to 40%, right? We're strategically coming in. Now, with this, right, there's really no special rules here, okay? I always start at the 0.5 typically, but you can control this based on your own risk level. Some people, maybe you want to get in a more risky scenario, you might start at the 0.38, or you want to be more conservative. You might not start putting into the 0.618. Also, it's important to note, just because we're hitting these numbers on the way down and 1 is our last, it does not mean that the price cannot fall below the 1, right? So again, this is for long-term investment. This is for something that I don't mind leaving in the market because I was going to put that money in the market anyway, okay? So this is me additionally saying, look, I'm going to put this money in the market anyway, but I want to take advantage of a time in history, right? A snapshot in the market where people are completely scared and the prices are really, really, really low compared to what they potentially would be. So let's take a quick peek of what that looks like around the COVID crash, okay? So let's go ahead, I'm gonna delete this one. Now, what I'm gonna do is, so we're gonna pretend that we started to see the market go down. Now, again, I'm on the weekly chart. I like to be zoomed out. Here's what it would look like on the daily chart. As you can see, it's a little bit more things going on. So I don't want you to see this and like think that that's one day. Each of these bars represents an entire week of trading. So let's just say the COVID scenario starts kicking off and the prices are going crazy here, right? We start seeing the drops and people are panicking. So right now, that is the top, right? And our last big bottom is down here. So let me grab the tool. I'm gonna start at the bottom and I go left to right, right? So I start at the bottom and I go to the right, right to the top, okay? And so now I have my Fibonacci lines on the chart. Now, if I wanna put $5,000 in here, then let's flow through and take a look at what that looks like, okay? So we hit the top, we started dropping. So you can see here, we're being patient, right? There might've been a lot of people saying, you know what, this COVID stuff, it's gonna blow through quick. Like, it's not gonna affect us. It'll pass quick, right? And so maybe they're like, all right, there's a nice little dip. I'm gonna jump in around here, right? Because the price at that point had dropped about 7%. Then it drops a little bit further, like, oh my goodness, what a deal. Let me get in, right? Now the price has dropped about 12%. What happens then, right? It keeps going down. So us, we're a little bit smart. We're going to wait, be a little bit more patient. Say we get in right here, right? The price comes down and touches that 0.5, right? So in that case, say we have $5,000. I'm going to put in 10% first. So 10% of 5,000 is 500. At the 286.42 price, I'm actually only able to get 1 share. So again, you can play with this however you want. You might say, well, I want, I can only get 1. It's like 1.8 shares or whatever. So I'm just going to round up to 2. You can do whatever you want, but let's just say we're following. We're not going to put any more than what we allocated. So if I'm going to put $500 in, the price is 286. I can only get 1 share of this at 286. Now what happens, right? It actually goes up the next week. It actually goes all the way back up. So if we actually wanted to, we're actually already, as you can see on this line, it went all the way back up to the 0.23. It actually went up 10%. Our investment actually went up on 10%. Actually, if we're trading or whatnot, we can cash that out. Now we have that money back in our pocket. Anyway, we're holding on to it. We're not doing anything. We're just being patient. Then what happens? It goes down, right? We see it come down 0.618, right? So now we're gonna go ahead, when it hits this number, right? We're not gonna front run this. We're gonna wait till it hits. Because typically, right, we're like, oh, I wanna make sure we get it. And what happens is sometimes it'll come down, it'll touch and go up, but then it'll just fly back through. Like, I wanna catch it as it's falling through. So I'm gonna put whatever number is listed here. So 0.618 hits, I'm putting in 20% of my investment. So 20% is $1,000. So I have $1,000 to invest. The price is $273. So that gets me 3 shares. That's all I can afford with my 1,000. Okay, then as we see, it actually comes down and hits the 0.786. So now I can put in my 30%, which is 1,500. I'm taking 1,500 and buying shares worth 256. That gets me 5 shares. And then it comes down and actually hits my 1 level. So I put in 40%, which is $2,000. And I'm using $2,000 to buy as many shares as I can for 233.72 cents. Gets me 8 shares. So as you can see here, as I was alluding to, look, it actually comes below this. But again, this is money I was going to put into the market anyway. So I'm taking a chunk to take advantage of it. Because if we think about just the normal monthly DCAing, right? You may be like, well, Jason, I'm just putting in monthly. Cool, not that big of a deal. Absolutely, keep doing that, so am I. But what's happening here, as you can see, this giant dip in the market. So I've been DCAing, like, right, all these, right? Every 4 of these is 1 month. So say once a month, I'm putting in money. So I'm putting in as it's going up, 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 so on and so forth. But then it has this massive dip. Well, I'm still putting in, right? But how long was this? Let's see, from the drop all the way until it started recovering. Let's just say until it got back up to the price that it was. It's 167 days. So a little under 6 months, right? So like 5.5 months, something like that. So if I was putting in, say, $100 a month, right, at 5 months, so I got $500. So I took $500 that I got to put in the market over this period of time. But, I was buying, maybe I got in up here, maybe I got in here, but then I got maybe here, and then like up here, right? So I didn't really maximize this giant drop in price. But based on what I just did, buying on the way down, because as you can see, it starts coming back up, okay? I ultimately ended up investing $4,262.12. And the cost basis, when we average all that up together, it's the equivalent of me buying just once at $250.71. So right here. So it's the equivalent of me taking $5,000 and putting it all in down here. Whereas if I was just all I did was the DCA, right? I bought up here, I I might have got one down here, but then I'm back up here, So my average, might have been up here. And again, I'm just free flowing it in terms of guessing, but that's kind of what it would have happened, right? Whereas I'm taking advantage of a specific drop using my strategy. So it's the equivalent of me taking $5,000, which if I'm putting in $100 a month or $200 a month, that's the equivalent of a lot of months that I condensed and put in at a very low price in the market, okay? But as you can see, this is where my cost basis was from following that strategy, and just it going back to the top, essentially back to where it started. We take the ruler, we go from here. That is a gain on my money of 35%. So just the market going back to where it was, I've already gained 35% of my money. And on 42.62, just rounding that to 4,262 and leaving off 12 cents times 35%, that I gained basically $1,500 already, right, in my money. And now the market is back to essentially where it was. So, and as we can see, I got in down here on this COVID drop, right? So here's my average down here, right? And from the top of where we ultimately ended up going down again, that's a 90% gain, right? So essentially it's just a little over $8,000 that I turned my $4,200 investment into. Again, that's on top of my DCAing. I was still DCAing, right? The market ended up still going up, but I just got a whole big chunk of money in at a very low price, okay? And so again, it's just a very easy way that I can get into the market during a dip with a bigger chunk of money than what I would normally put in on a monthly basis. So I'm going to do the same thing, right? So I'm going to do the same thing, go to left to right here. I'm going to wait till it starts coming down. This is one of the assets I'm probably going to put into. There's some few other assets that are kind of my longer term, but this one I'm going to use as a short-term strategy. So this one I'm essentially going to kind of work my way in, invest my way into it as it's coming down. And then I'm probably potentially just going to sell it once it gets back up close to where it was, okay? And actually the strategy I use for that is kind of a reverse. So let's just pretend, so I had 250.71. Let's say I was going to do that. It's close enough, 250.73. Actually, just put it 250.71. Let's say I was just going to short-term trade this, right? So I got in on this nice massive dip. The way I'm going to exit out is almost like a reverse of what we just did. So I go left to right, but instead of going from the bottom here to the top, now I got a top and a bottom, right? And the price is going back up. So I'm going to put my fib here and bring it down. So right, left to right. And now what I'm going to do is I'm going to start exiting my position. I'll typically exit out in either 25% intervals or 33% intervals on the way back. So essentially I'm going to get out when it comes back, when the price comes back to the 618. That's where I'm going to exit, take my first profit out of the trade. Okay. So in that instance, 250.71 is where my cost basis was. So as soon as it goes to 0.618, I'm already up about 17% on my money. And that's where I'm going to pull out the first percentage, right? I may pull out 25% of what I put in. Again, I'm talking about if I'm just going to short-term trade this. This strategy I primarily use for my long-term investments, okay? But 0.618, it comes out, or I start taking a percent out. Then when it hits the 0.78 on the way back up, I'm going to pull out 1%. Now I'm 25%. That's a 25% profit. And then when it hits the 1, I'm going to pull out another percent, say another 25%. That's 35% profit from where I entered. And then once it hits the 1.272, I'm going to pull out probably half of what's left, which is about a 50% profit. And then I'm just going to let the rest of it ride, and I'll pull it out whenever I get antsy, right? So that way I've profited it on the way up, and I still got some in the market to let it run. So again, potentially the rest of that goes all the way up to 90% if I'm smart enough to get out then. But anyway, you can use that in reverse to kind of get out, just kind of change up how you want. And again, you can be as conservative or risky on that as you want as well. So again, I'm primarily sharing you this strategy to use as a long-term investment of stuff you're not going to care about, stuff you're going to be patient with and let it run. Because again, there's always a risk that it doesn't always go back up. Okay, so remember, we're investing. This is risky. So you only do this with what you can afford to lose, what you're willing to lose. So understand that, right? And that's also why I typically am using this as a long-term strategy, something that's going to sit in the market for a while. And you know, it doesn't just work for equity markets. Again, it's whatever that we can chart, right? So here's Bitcoin right here. Just as a FYI, I got the fib in place from the COVID low all the way to the top up here. And so I'm doing the same strategy here. Again, each asset is different. As you can see, there's a giant gap between 0.786 and the 1, right? There's a 78% drop. So I'm actually hoping we don't make it down there, but it's a possibility we can make it down there and even go further. So again, this is why I typically use this long term. It's typically assets that I don't mind holding for a very long time. And again, you can only put in what you're willing to risk. So if I lost all this, then I can't let it bother me, right? It has to be money that I'm willing to lose in the market. So again, just wanted to show you, it really doesn't matter what the asset is. If it can be charted, and you can use this strategy with the fibs. And again, if you did this back in the COVID crash for Bitcoin, right? You're talking quite a massive, let's see, like say your average probably would have been, you know, whatever, around 5,600, 5,500. You go up, and I mean, it's a 1,130% return on your money, which is, you know, on $5,000 times whatever, that's, you're looking at your 5,000 turned into 56,000. Again, assuming you held it all the way up, you're still holding it and all that other fun stuff. Anyway, ultimately, the flip the dip strategy is a great long-term investing strategy. Again, you can use it for short-term trading. You just, again, have to be careful with it. Again, be willing to lose that money. You have your own risk tolerances. You have your own investing portfolio strategies. Just sharing what I do. If you enjoyed this, again, appreciate a like, subscribe, share, and also let me know in the comments if you do something like this, if you like this strategy, if you have something else that you like to do during big market pullbacks. Love to hear it. All right, with that, I'll see you in another video.